Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome back as we bring you yet another episode of Pasture to Pin. I am your host, MT Rowen, recording from my office in Hereford, Texas. We missed our last scheduled episode as my wife and I welcomed a new baby boy into the world. We are back on track this week in this episode to talk about some interesting aspects taking place in the cattle markets. And as usual, I am joined by my compadre on the cattle trail, Mr. Trey Freeman. Trey, welcome back to the show.
Good to be here again, MT.
I am always happy to have you here, my friend. Before Trey and I dive into this episode, happy April and happy April weather to everybody. Spring is in the air, which means the sun is out. The wind is ripping across the plains. Precipitation outlook appears to be normal and above normal for most of the central U.S. Trey, please take us through the happenings in the futures market, sir.
You bet. Monday's sharply lower reaction to the bird flu story is a case where money flow trumped fundamentals. Basically, funds read the headline and many cashed in. They had added to their net long position week over week since mid-January up until these last couple of weeks. So they rode this thing for a while. This mass exit spurred some panic selling and together led to the dramatic sell-off. Looking back, it took May feeders 2.5 months to rally $46 and only 6 days to give up nearly half that. And same in live cattle, with June giving up 40% of its gains over the last 2.5 months and August 60%. Looking at technicals, today was an inside day on the charts. May feeders managed to close above the 100-day moving average after closing below it yesterday for the first time since late January. This opens the door to psychological resistance at 250 and then the 50-day at 254.50. Support below sits at Monday's low of 240.85. June live cattle closed a few ticks above the 100-day, finishing at 176.37. This opens the door to 180 and then the 50-day at 181.70. Support sits below Monday's low of 174.15. Overall, bull markets need to be fed. Placements didn't meet expectations in the latest cattle on feed report released a week ago. This was a bummer, and especially when considering a little bit of a pattern of trade expectations coming below actual placements in the last few cattle on feed reports. And then damage to the charts from the bird flu headline. There's just no bull fuel over the last month, having led to a sideways trade and eventually tiring out over the last week, really even before the bird flu story was published.
Thank you very much, Trey. On to the cash side. The feeder cattle cash market has continued its sideways trade since our last episode on March 5th. The CME Feeder Cattle Index 7-day average actually moved up $4.90 from $496.90 to a high of $251.81. Since March the 20th, it has now lost $4.14 and sits at $247.67 as of March 29th. The live cash cattle market has also found itself in a bit of a sideways trade. It was $6 to $7 higher to a peak of $190 live since our last episode on March the 2nd. However, due to concerns with avian flu entering possibly the bovine species, live cattle prices have backed off $1 to $5 in a range of $185 to $189. Trey, we've both mentioned this avian flu issue. While I do not want to dwell on it, I do not want to speculate. We have to face the fact that the cattle complex has reacted to the avian flu twice now. Once last week when the USDA released a newsletter, and then again just yesterday when news broke of a human testing positive for avian flu. Now, here are the facts that we know. The first signs were seen in the dairy herd. Symptoms were mainly seen in older milking cows. Milk production would drop off, coupled with scours. 1 to 2 weeks later, the cow would basically make a recovery health-wise. Now we have a human case. This human worked in a dairy. His symptoms were similar to that of pink eye, and now he, thank God, is on the recovery. Trey, knowing these facts, but seeing the market's reaction, what are your thoughts conceptually on managing risk going forward?
You got to be on your toes. If you have deep in the money puts, I like rolling them down and putting that cash in your pocket. That way you're retaining a floor if we see another leg lower. But if the market rebounds, then it can't take all that increase in value away. And if you're familiar with option spreads and comfortable with the risk reward that they pose, write down targets to leg into to collect on some volatility premium, mostly on put spreads, but don't get carried away. There's certainly still some major downside risk. Be patient, and if opportunity doesn't arise, don't force it just to get lured in. Patience is a virtue, and this is especially true when selling options. Now, calls, I don't like selling them anytime soon after such a flush. And now, short futures, consider buying calls against them if reasonable value to help offset margin calls on a sharp rebound. If you're selling feeder cattle in the next week or two and have no protection, consider buying cheap puts in April, or at least be on your toes to strike if a window opens when volatility settles down a bit. Which this is a great example of where having a brokerage account has value instead of just having an LRP policy. You can't buy LRP less than 13 weeks out, but you can buy put options that expire much earlier to cover your feeders that are going out as early as the next few days. Just something to consider. Now, if you're selling fats later this month and need protection, well, April options go off the board in 3 days. That's not enough time, and June's the next contract out. Well, you don't want to pay for the time value of an option that expires first week of June when you expect to sell those cattle in the next 30 days. So consider a short-dated June live cattle option that expires May 3rd, and it'll be cheaper because of less time value.
Trey, thank you very much for that. It's events like these, we like to call them black swan events. Whether this is a black swan or not, to me, this just brings home the point of making risk management, whether that be futures options, LRP, or some combination, just brings home the point of making risk management part of the routine. We never know when something like this is going to happen, given the modern day flow of information, whether true or not true. We never know when a headline is going to break or when something is going to break on social media and bring the market to the downside. Obviously, as you have pointed out, we move higher a lot slower than we move down. We seem to move down with rapid speed. Often an event like this is coupled with a stark move lower in the markets. So making risk management part of your routine, whether that's layering in 10% at a time, whether it's going 30% or 50% to fully covered. In my mind, this brings a rhythm of buy cattle, buy protection, sell cattle, risk off, repeat. So again, that's just where my mind goes is to make due to events like this, make risk management part of your routine. That is a wrap for this episode of Pasture to Pen. Thank you to all of our viewers for watching this episode. If you have not done it yet, hit the like button, hit the subscribe button, and click the bell to be notified of future episodes. A big thank you to Lexi, who captained the ship for us today. And as always, a big thank you to the EverAg Insights team for making this show a reality. I don't say it enough, but also thank you to Trey for being my co-host on this episode. Until next time, stay safe and pray for rain.